Well, good morning, everybody. Welcome to the latest Startup Factory.tech webinar on our series of sharing our experience, guidance, and advice to early stage startups. Today is one of the most popular topics and one of the most frequently set of questions that we get asked by many startup founders. How do we go about early stage funding? What are our options? What's the landscape? Who do we talk to? Where do we find these people? So what we've done is pull together our most recent experience, war stories and all, and also giving you a bit of an insight on the process, how to engage, but also a feeling for where the market currently is, because it's a pretty tricky early stage funding market at present. So today's agenda, we're going to rattle through quite a number of areas. I'll keep it light, I'll keep it conversational. The deck will be available. We are recording this. And of course, we're always open to the good old-fashioned, let's have a chat, let's have a conversation about some of the issues. So I'm going to just take you through, really, as I say, from our experience, the way you should look at engaging, who these people are, what they're looking for, how to give yourself the best chance of success, and then we'll have a Q&A at the end. I don't know how many of you have got experience of fundraising for your own venture, or indeed some of you are going through the process or thinking about the process. It's one of the most rewarding, one of the most frustrating, one of the most time-consuming, and one of the most impactful things you can do as a startup founder. But obviously, there's a contradiction and conflict between some of those characteristics of raising funds. So just to give you a bit of insight on where we are currently and what the market is like. The Startup Factory, we've been around for nearly 5-6 years now. Our model is sweat equity, but we do help our startup ventures raise funding. So we're pretty well connected with the early stage, seed stage, angel networks, and the kind of the public sector bodies that help originate startups with funding. And currently, our anecdotal experience and direct comments back from some of the more active players in the market is that they're receiving 250 decks quite regularly, in fact, each week, and focusing on, we're startups, we're pre-revenue, we're looking for funding. So that tells you the appetite. Unfortunately, the supply isn't quite there at the minute. And when you've got that imbalance between demand and supply, how you stand out from the crowd, how you make yourself the one they should look for, is becoming much more polarized. If you look back at the previous 2 years, there's been a lot of bets made on new and emerging tech startups, and there's been a bit of fear of missing out, if I'm honest. I think from a lot of investor groups and angels. But the whole sentiment has changed. And previously it was, that's a great idea, that's a great founder, good team, see the potential, the plan looks great, I'm confident they can execute. Has changed dramatically to what's your path to profitability. So if you are pre-revenue and haven't got any traction, it's going to be very, very hard. Balancing that, of course, is this path to profitability is the new mantra, is they are looking for the ones in that 250 deck supply, but also they're kind of conscious about their existing portfolio. And we saw this at the start of COVID, where there was a dip in startup funding, where investors wanted to shore up their existing investments. And we're seeing a little bit of return to that as well. I think there's also the sentiment that's come across from Silicon Valley and the US that unicorns aren't quite what we all thought they'd be. There's been a number of headlines, Tyrannos, WeWorks, where they raised billions. and through a combination of poor due diligence, founders not delivering and never getting to profitability, the emperor's new clothes syndrome of we need to be in this just in case it's a bet that could work, is definitely washing through the tech startup investor community. And we're seeing very much a focus on three pillars: AI, ESG, and health tech. They're the three that currently are really flavors of the month. But don't be tempted to lean into AI and try and create a badge for AI in your venture, because that will soon get found out as well. So bit of a health warning in terms of that's where we're at currently. It's not impossible to raise. There's still obviously great opportunities. But on this slide, the first 3 or 4 points are really about the macroeconomics as well. And that is cascaded down into the whole environment. Quote that was given to me at an event I went to last week: rejection is fast, hard, and frequent, which as a founder is kind of a hard message to take. The underlying reality was, and this came from one of the heads of one of the preeminent VCs in Manchester, you have to talk with 3 times more VCs to raise half the round at half the valuation currently than you did in 2021. So you need to be pretty thick-skinned, you need to be well prepared, you need to have a compelling story. And just bear in mind that earlier comment about path to profitability. Yes, you've got some great innovation, you've spotted an opportunity in the market, you've got an interesting capability in your team, you can sell, but the money supply is scarce. So it's a lot harder than it was. Okay, so let's just walk through some of the funding options that are available to a startup. Some of these are obvious, some you'll be aware of, some perhaps less so. Obviously, your personal savings and funding, bootstrapping your venture, paying your own way, and kind of owning 100% is where most startups start their journey. And bootstrapping, I think, is something to really think through as to how far you can go. Obviously, perhaps not at the speed that you want, because funding does enable you to go faster. But looking at your own personal savings, and then indeed friends and family, what I call love money or patient capital. You'll obviously, well, you hopefully obviously will get a more friendly and more benign set of investors from friends and family. But that obviously brings a change in the relationship. We've seen some ventures work really well, where friends and family have provided 6-figure sums. But obviously it does change the conversation every time you get together as a family. How's it going? Are you making progress? When do you think you're going to pay a dividend? And those sort of questions and conversation pieces do come up. So be very mindful before you go down that route, because it just does change that dynamic. Although it's the fastest and cheapest route to additional capital, and the patient capital phrase I think is quite pertinent, because you're obviously not under pressure. If your mum and dad or your great auntie Nairi or your uncle James lends you a bit of cash, they're doing it to support you and genuinely giving you that support. But just be mindful, like I say, it's kind of an arm's length relationship, but they will expect a return. Sweat equity has become more common. That's the startup factory model, where we provide resources and expertise, and rather than being paid in cash, we get paid in shares and equity in the venture. There are a number of ways of building your founder team to do that. So if you're a solopreneur and you want someone with tech experience, want someone with sales experience, then kind of enabling your business to go faster and build those capabilities by offering capable people a percentage ownership in the business can be quite lucrative. Typically, we've seen between 2 and 5% of equity being given to what effectively becomes the co-founder team. And again, that's a great way of fast-tracking your growth, bringing in some like-minded people, bringing in some skills, building that team faster than you'd be able to. And you also get people who are aligned to what you're doing and you personally. They kind of have got the ability that you need, and they've got the capability to take shares rather than cash. So sweat equity, I think, is a route you should consider if you wanted to build your team. Customer revenue, however, remains for me the focus of, rather than rushing out the door with the pitch deck and trying to get as many investors on your cap table. Proving your products or service has got market traction is the primary goal of any startup. And the second stage of that is turning those early advocates or those pilots and tests into paying customers. Really gives you validation. So it generates the revenue, generates the cash, doesn't give you any issues around dilution. And of course, then leaning forward 6, 12 months down the line, when you do need to raise a chunk to either build out the sales team or take your MVP to the next stage, then investors can see that you've actually got real market traction and you are generating revenue. And that path to profitability mantra then becomes a more easy conversation with them. So I think friends and family, sweat equity definitely help you get there, but customer revenue for me is where you should be focused. Chase customers, not investors, in that first 12 to 18 months. You may not be able to go as fast or as deep as you want in the development and growth, but you are building a sustainable business that is more investable. And regardless of how big you see your opportunity, we will have to have a mind's eye on the environment in which we're operating. And like I say, the investor market at the moment is challenging. Two other options: invoice financing. Again, once you get to a certain level of scalable sales model, repeatable customer orders, then there are financial institutions that will advance you cash based on the invoices that you're raising. It's quite an expensive source of funding, but again, you retain your equity. And again, looking at a blend of funding solutions, invoice financing is something you should consider once you're kind of at 100, 250K revenue, where, you know, meaningful chunks of that 10 grand, 25 grand can be advanced to you, is a good source of funding. And finally, crowdfunding. I think we're all familiar with Brewdog and their Equity for Punks scheme, which really got their business off the ground. There are a number of crowdfunding platforms that you can go and look at. Again, it's relatively expensive, but it is about customer validation as well. Folks that want to invest in your business through a crowdfunding scheme are obviously advocates and customers of what you offer. So that does bring a double benefit in terms of opening their wallet to get investment funds, but also revenue in terms of buying your products and services. Down the track, there is a little bit of friction with more traditional investors. If you go down the crowdfunding route, you could end up with 50 small investors. And equally, the terms and conditions of crowdfunding, you need to be quite mindful of. And there are a number of VCs that will not consider investing in a business that has got a crowdfunding existing base. So worth having a look at. There are a number of platforms on the internet, and we're more than happy to help you with those conversations. The next slide is more the kind of institutional, traditional routes. The British Business Bank was set up a number of years ago precisely for early stage ventures and SME funding. They offer a range of schemes which, again, aren't as painful in terms of cost or as onerous in terms of commitment. So I'd encourage you to go and have a look at their website. One of their routes to market is through the Startup Loan Company, which I think is a really genuinely helpful scheme, where they'll offer you a startup loan of 25k. Current terms are on 6%, and you repay it over 5 years. There's also quite a generous and supportive set of terms and conditions around default if your business fails, and that it doesn't become a personal liability. So again, those kind of opportunities I think you should look at. Innovate UK offer periodic competitions, smart grant awards, very much leaning into technology innovation. So why they want to invest this government money is to create jobs and to spark genuine tech innovation. So again, you need to be mindful as to what your business model is, where you sit, what it is you're trying to achieve. But these grants, again, can be very helpful. We've worked with a number of startups at Startup Factory that have kind of raised £250,000 from Innovate UK. So again, they can they can be quite helpful. And then the final three are just the traditional routes, really. A lot of incubators are now offering funding plus support of mentoring and coaching and business advice. Baltic Ventures have just opened in Liverpool, and they've got a really supportive model around that. Their first cohort has just been announced. So it's a national scheme. You don't have to be based in Liverpool. So go and have a look at Baltic Ventures. And there are a number of others that are operating now that realise that they need to offer financial support, not just moral energy and ad hoc resources. So there's a lot of help out there. You just need to find the one that's right for you and where you fit. And then the other two routes, angel investors and VCs. Angel investors are really helpful and really benevolent, typically entrepreneurs that have been through your journey, so they understand the trial and tribulations, the challenges. They'll typically write checks of 25,000 plus, and of course they bring experience. They bring a set of medals and scars to help you and help you with your decisions and grow your business. And then VCs, where typically they're looking at $500,000. So there's a range really of options that are out there. Take your time, go and look at them all, from friends and family. Could you raise a second charge on your property? Is that something you want to do? Through to grants and startup loans. So I think getting a blend of funding is something you should consider. Don't put your eggs all in one basket. And certainly this frenzy and focus on I need to raise a round, we think is misplaced. Bootstrap for as long as you can, and then go and look at your options and see what's available. Pros and cons, and we'll touch on a couple of these points later on in the webinar. How much funding you need and how much equity you're willing to surrender are key things you need to think about. Chances are, once your business gets traction, if it is successful and your margins and your costs and your cash are well managed, then really, unless you are a capital intensive business and your tech is a really significant development, then you can start to think about organic growth and organic cash flow. But you may need to raise a second round or even a third round. So as a founder, think about the dilution impact and how much of the equity you're prepared to give away today, the next round, and the round after that. I mean, we like to work with founders where they've thought through this and they end up with typically between 30 and 40% after 2 to 3 rounds. Ballpark, I think that's where you should look to end up. You founded this business, you put the effort and the heartache in and the risk, and you need a reasonable chunk of this going forward to reward yourself. Equally, we know some people that have kind of become a bit of a hostage to fundraising and now have ended up with less than 10% of the equity, which for me doesn't seem fair, and certainly they haven't respected themselves. Things to consider are the terms, the process, the time, and the fees of funding. How quickly the process is. Some of the VCs obviously will want to do due diligence, which can be quite deep. They will then charge you ongoing monitoring fees of about 20, 30K a year. So there's lots to consider, the pros and cons of various options. The key one is also expectations. Angels are much more empathetic to the journey, the time. They know that you've produced a plan that says, here's where we'll be in 6 months, here's where we'll be in 12 months. They've been through this journey themselves, that they know it's going to be 12 to 18 months in reality. But they're a form of what I term patient capital. VCs, less forgiving. You've given them some promises and commitments to, and milestones to hit, so expectations are high there as well. So just think about, again, the relationships and all these factors, I think, are important when considering the various options. So where should you look for funding? There's a range of networks now for startups that have really got some depth and breadth to them. Certainly post-COVID, there's more face-to-face events. There's a lot of online events still. But whether you're based in Manchester, Liverpool, or Leeds, there's a lot of networks now that you should look to plug into, where there's like-minded people, there's businesses that are supporting the ecosystem, and obviously that attracts the investors that are looking to take part in some of these startup ventures. So networking, I think, is one of the first ports of call, and attending the events and getting into the various startup communities, where obviously there's a bit of competition because there'll be other startups looking for investment as well. But certainly the focus of time and effort around networks and events, I think, bears fruit. And at the end of the day, I think that you still can't beat that face-to-face connection, meeting people and letting investors see your personality, your energy, your enthusiasm, your knowledge, and building that rapport. Investors invest in startups because of the founder. Again, we'll come on to that. LinkedIn is becoming increasingly a good source of startup information and knowledge. Obviously, it's used to broadcast webinars like this and helping connect the communities. But equally, there are a lot of startup investors and angel investors in particular that use LinkedIn as a way of connecting. I probably get 3 or 4 decks a week sent to me, totally unsolicited, because of my LinkedIn profile and obviously my connection with the Startup Factory. So I know LinkedIn is actually quite fruitful in terms of filtering and targeting interested people with funding your opportunity. You then have to filter that again. But again, in terms of sat in front of your desk, it's quite easy to target, profile, and connect, and run a campaign for yourself to connect with a number of investors. Accelerators and angel networks are kind of, again, becoming more and more places to gather where like-minded people are. Accelerators, that combination of support and investment. And angel networks, I think what angels have realized is that both in terms of opportunity gathering, but also risk, collaboration with investors, with like-minded and similar investors, is a very fruitful and cost-effective way of finding and identifying good startup opportunities. So there are, again, a number of angel networks. David Levine runs Manchester Angels over in Leeds. There's again a good network called EHE, which Stuart Brown runs. So again, the opportunity for connecting, and each of these networks gives you the opportunity to connect with a group of angels. And therefore, if 4 or 5 are interested in investing, you can quite quickly raise a 6-figure sum because they'll each put 25, 40K in. And then just simply an internet search. So I think it's all about you putting some effort in, finding out where these folks are, how they operate, what they're looking for, but you stepping into it, you being proactive in networking and events and on LinkedIn. I'll just put this slide here, and I've termed it "Build Your Social Capital," because again, you've got to make your profile stand out from the crowd. First and foremost, build your LinkedIn profile and the content. Use LinkedIn from a personal point of view to express opinions, but also have a LinkedIn profile for your startup venture, where you can showcase your knowledge of the market, your understanding of the opportunity, but your own personality. So you can be a bit more provocative and opinionated on your own profile, but build followers on your company LinkedIn and focus on a content strategy. I've then used the phrase "swim where the fish are feeding," and it kind of probably relates more to the previous slide. You know, go where there's an active community. From a time and a cost point of view, your hit rate of looking to raise investment, or at least having those initial conversations. But you've got to build your social capital and focus your outreach in terms of those people that are interested. So, for example, there are a number of investment houses at the minute that are just focused on AI. Some are just interested in specific sectors, deep tech, health tech, etc. So not all wallets are your wallets, is the phrase I'd use. That don't expect everyone to want a conversation. Rejection's hard, fast, and quick, as I said in one of the earlier slides. So if you're looking at investors, make sure that they've got a track record of investing in similar businesses, either in your sector or in the supply chain in your sector. That will rule them in or out. Some will invest in SaaS, some won't. Some will invest in hardware, some won't. So again, be very focused and diligent on doing your homework to identify those that are relevant to you. And then it's all about preparation. You know, first impressions count, the follow-up counts. It's about storytelling, not exchanging business cards. I'm not sure if people still do that in the digital age, but this is about creating an impact. So making sure that people know who you are, that you're interesting, you've got some credibility, they understand your track record, they understand what you're trying to do. They're investing in you. And so preparation, identifying who to approach, what your opening line is, who you are, what you're doing, and then follow up. Investors, like I said earlier, are inundated with opportunity. That's one thing they're not short of. How are you going to make sure you stand out from the crowd? I think it's important that you do recognise that you've got to put a lot of legwork and footwork in before you even go and approach investors. Don't do it in an ad hoc basis. Really kind of build out a campaign. It's no different attracting funds from an investor than it is attracting funds from a customer. You want them to open their wallet. You want a reasonable share of what they've got, but you've got to evidence value. So all this preparation, I think, is important rather than just doing it on an ad hoc basis. Okay, so what do investors look for, and what do they want to hear? It's kind of understated but overstated. They're investing in you. At the moment, you've got the kernel of an idea. You may well have got a prototype. You may well have got an MVP. You may have got some early customers, but have you got a viable business that can give them a return that's going to scale and build out to something meaningful? We don't know at the moment. So they're investing in you, your credibility. So it's a bit like an interview for a job. It's a bit like trying to kind of get people's attention. It's a very crowded landscape. They're investing in you. Then they invest in your idea. They're looking about its potential. They're looking about the execution plan. Can this person build a business? Do I think they can build a team? Have we had a reasonable conversation about risk? So it starts off with those first impressions and what you say, how you say, you know, that first 5-10 minutes, and then developing it into a relationship. And of course, they're evaluating you and they're processing what they think about your idea and the opportunity. They've also got another meeting that afternoon with another startup. So they're benchmarking you and your idea against other opportunities. So It's a very, very competitive game, startup fundraising. And you need to keep that balance between being energized and enthusiastic and not being kind of over the top, me. You've got to invest in this. It's the best thing since sliced bread. So again, be mindful about how you want to come across, construct the story of your journey so far. And it is about storytelling. If you look on the TSF website, we have a number of blogs around storytelling and creating hooks, creating interest. It's less about a pitch, it's more about a story. And again, we'll come on to that. They're investing in you, and some of this, I think, is born out of painful experience. When I first started, your enthusiasm becomes too evangelistic. And what you're looking to do is create an impression about, yes, I can trust this person with my money, and they're going to build something of substance here. So be optimistic, but not hallucinogenic. We did have someone come to us a couple of years ago who just walked through the door at our office and said, I've got an idea for a search business that's going to beat Google. And you loved his optimism, but goodness me, it wasn't an opening line which kind of you thought, yeah, this guy's backable. So be optimistic, be positive, be mindful that what you think and know about your opportunity in your market is that investors are hearing it for the first time. So be open and transparent. Yes, there's competition in the market, but this is where I think we've got an edge. There's some near-term things that I need to do first that I'm not sure about. So make it a conversation. Like I say, people are hung up on pitch decks. Pitch decks are a fixed narrative. And if I was an investor and sit their side of the table, I'm getting 250 of these a week. I actually want to get out of the office and have a coffee and meet some interesting people who've got an interesting idea. So again, kind of make it more of a human interaction. That's the way you will form a relationship. Investors don't read pitch decks. It's quite frustrating when you send them, you then get a meeting and that you sit down, have the usual pleasantries, and they'll go, look, I'm really sorry, I've just not had the chance to read your deck. So try and create this social capital connection and more face-to-face. Start to socialize your idea. And again, use that to filter those people who could be interested in you. A couple of points here about where they're sitting. So sit their side of the table. We always like to look at founders in terms of what sort of relationship can they have with other people. Yes, we know we can work with them. They seem very open to listening about tech. We can add to their thinking, but can this founder sell? Do we see them getting in front of customers, explaining their proposition and closing some business? Can they build a team? Can they build a culture? Can they get respect and trust and build energy in a dynamic team to help take the business forward? And at the same time, are they bang full of great ideas where they're innovation-led? I'm looking for someone here who's going to build something new. It's going to take a team to get it there, but it needs customers. And help connect the dots. One of the questions that I've seen over the last 2 months particularly is, Ian, that's really interesting. We like some of the ideas that you're putting forward, but why you, why now? And it's a great killer question. It's a great close question from an investor's point of view at the end of the meeting. And you've got to be very agile and thoughtful as to why me, why now? So again, practice and be prepared for that question. And if for some reason it's not asked, reverse it at the end of an investor conversation. Why I think you should invest in us now? Well, let me tell you why us, why now? It's quite compelling. You're on the front foot. And again, I've seen investors really like that expression of confidence. Equally, if you're going to work with an angel, then they're looking for people who will listen. We haven't got all the right questions, let alone all the right answers currently. So they're looking for founders that will listen and take on board experience. Yes, they're confident, they'll make decisions, that they're driven, they know where they're going, but equally there's a degree of humility in a founder. So while you want to express confidence, understanding, knowledge, and even a bit of wisdom, A bit of humility doesn't go amiss. And equally, investors looking for relationship builders, not just money makers. Back to the point around, can a founder sell? Can a founder build a team? There's no such thing as a solo founder. There is at the outset, but in a venture, it's all about the team and people. So again, just some thoughts there as to investors are investing in you personally, but they're also looking at your ability to build a business. A couple of points we've touched on here, really about the kind of the style of how you engage with investors. Don't peck their heads, don't berate them, don't come across as a Johnny Know-it-all. Understand your audience. Have they invested in this sector before? Why would they invest in this sector if they haven't done that? And equally, the temptation is to kind of get on the front foot and be energized. Go easy, relax, create the conditions for a good conversation. Be engaging, be transparent, be open. And back to my previous slide, don't sell your product, sell yourself. Sell your credibility, sell your experience. Why you, why now? Timing is one of the key things in tech. And explaining to an investor why this is the moment they should be investing in you and not one of the other opportunities, I think is important. You're selling yourself, but take a step back. Don't make it a frantic bullet point driven pitch. Learn your script. If you're meeting an investor for the first time, meet for coffee. Don't give them a deck. Just have a conversation. Take some notes with you. Have a notebook by all means. They won't bother around that, but get them out of the office, get them into a coffee shop, make it a relaxed environment, and use the time to start forging a relationship. And just start with this simple 20-word tagline. This is what we do for a living. This is why we're famous. This is why people will buy from us. Sit the investor's side of the table and think about those 3 points. And I think you start to create that degree of engagement. Storytelling is really important. Equally, I think where you've come from and where you're going in terms of unpacking that learning journey and focusing on the mistakes and the wins that you've had to date. Start to lean into some of the business stuff if it's appropriate. Why you've got some defensibility, what your roadmap is, what your route to profit is. And again, kind of sow the seeds and feed their interest and intrigue. It's all about the ability to execute. They're looking for people who've got a great idea, but they can make it happen. Equally, some investors will kind of use your time for discovery and research, which I think is fine. You need to create awareness and interest, but really you want to find investors who get you and get what you're about quite quickly. Typically, you're going to look for 20 to 25 angel meetings, I think, if you're looking to raise a reasonable amount of money, so that there's a lot of time and investment in that before you even get to meet them. Then there's the meeting itself, then there's the follow-up. So you need to try and focus on those folk who get you sooner rather than later. And that's not ruling the outliers out that are kind of a bit slower or they're looking at other opportunities, but being focused on raising funds on a timely manner is really, really important. And just again, through experience, what I've called the anatomy of a good relationship, good human stuff, to be honest, on personal values. They trust you, you trust them. You're going to be on a journey for a while with these folk, and likewise them with you. So you do have to have some alignment. Alignment on the vision, what we're about, where we're going, alignment on success, what success looks like. And you've got to feel as you get into the relationship with any investor that there's a rapport there, that you can have disagreements. They will have a point of view, they'll have a perspective. They'll ask why you're doing this, they'll ask why that hasn't happened. So you've got to have some elasticity and strength in the relationship as well. So you want people not just for the money. You want people for their expertise, their knowledge, but also their support for you as an individual. So someone who you can pick the phone up and get advice from, but equally pick the phone up and say, do you know what, I've had a really bad couple of days, I just need to talk to you. And the angels are great like that, because as I've said, they've been on this journey with you. Equally, while they're on the journey with you and they're empathetic, they've kind of invested in you to make a return. So understand the boundaries. What are the red flags? What are the lines in the sand? How are they going to shape that? When things don't go to plan, how will they react? What do they want to see from you, and the timeline? And that is often linked to the frequency and the extent of involvement. Some angels would just give you the money, want a monthly update, a catch up. Others will want more knowledge and insight into how progress. Others will want a hands-on involvement. So again, decide what type of relationship you want with the investors. And obviously that will vary depending on the type of investor that we discussed at the outset. I put a link there, which again, when we send the deck out, you can access to what I think is the best ever Dragon's Den meeting. So all about being prepared, creating rapport, creating energy, bit of humor, being relaxed, being focused. I'm sure most of you have got experience of kind of tough meetings, but there's some really good Dragon's Den stuff on YouTube about what constitutes a good investor meeting and where it's just a disaster, what not to say at the wrong time and never get into an argument. So again, preparation and developing a script, but also just developing that filter as to the sort of investors you want and why you want them, I think is important. Bit of a rant on pitch decks, because I think giving yourself the best chance of success, I've called the next 2 or 3 slides, and pitch decks don't necessarily do that for me. It's a bit like a CV. A CV won't get you the job, it'll get you the interview. A pitch deck won't get you funding, but it will get you a meeting. So I'm much more a believer in relationships, conversations, building the rapport, building the domain knowledge, showing your understanding. And certainly those early meetings are important. And just some experience here: pitch to share your vision, identify and agitate the problem, spark intrigue. Yeah, I need to be in this. These guys are talking about something that is relevant and interesting. Show, don't tell. Don't lecture. Don't let your energy become evangelistic. Kind of create the conditions for a series of meetings, because it's going to be 2 or 3 meetings with investors until you start to talk turkey in the detail. Creating urgency and building trust, and again, potential. So this is quite an important slide as to how you use a pitch deck. If you want to use one, at some point you're going to have to put something down on paper. I prefer it's a summary of the business vision, strategy, the business plan, the execution, etc. How we're going to build this thing. This is what the journey we're on. I think pitch decks are pretty hackneyed and you can't stand out from the crowd. You see loads of stuff on LinkedIn. These are the 15 pages that Airbnb used. You're not Airbnb. You are who you are. People connect with people. Investors invest in you. So yes, they want some information, but invest your time in planning and thinking, and then showing them what the execution plan is. And you'll get some investors that want a 3-year financial model. And I just say no to that. I said, I have no idea what that looks like. I can give you a profile of my next 12 months costs and how I'm going to deploy the funds, and what some an indication of what I call my revenue map, the type and size of customers and what I think they will buy. But again, there's too much time focused on the pitch deck and the financial model for my liking. Know your stuff. And again, some things here which probably go against the grain of maybe some other advice, but don't raise the biggest round you can. Don't seek the maximum valuation you can. Firstly, you're going to rule yourself out a lot of opportunities. I'm looking to raise 2 million quid. It's a big chunk of money, you know, and what you're going to use it for and over what time period. And yeah, the old school of thought was that I've kind of got cash in the bank to then unpack and spend. A much more agile way of looking at funding these days exists. to get me over the next 18 months and focus on delivering these key milestones, this is what I'm looking for. And this is my current valuation. You've got to make it attractive valuation so that people see value in it today and value in terms of getting in early. Equally, you've got to respect yourself in terms of your own dilution, but you'll simply rule yourself out from a sensible conversation. I'm looking to raise £2 million at a valuation of 5 million. And there are a lot of people that are still pushing that out there, and it's admirable they have that self-belief, but you're not going to go in investors who are going to kind of go for 500,000 when you haven't even got a single payer customer. So again, these are more rules of thumb based on experience, based on stuff that's worked and stuff that hasn't worked. Depends on the circumstances, timing, etc. You know, every startup is unique and has a unique set of circumstances. But for me, I'd say look at raising for 18 months. It's a sensible time period. Gives yourself some time to develop your thinking, evolve the strategy, execute, get some results, go down some cul-de-sacs, pull it back and pivot. Between 10 and 20%, it's got to be reasonably generous to get an investor interested, but not hugely problematic to yourself. You'd rather raise the money than not. So you do have to kind of, you know, sit their side of the table and make it worth their while. What drives my valuation? Again, just typically what we've seen, early traction through pilots, through paid pilots, then revenue, and then scaling. Again, these are just rules of thumb depending on the sector you're in, your business model, what your revenues look like, what your cost base, what your margins are, what your cash burns like, etc. But there are definitely some slices to look at that investors kind of think, yeah, this is worth 2 million, this is worth 3. And your target valuation, again, be generous at the outset and then focus on evidencing value and producing results. And again, typically this is a stepping stone process that we've seen at the Startup Factory that engages investors, gets the cash in when you want it, creates the right sort of tone of relationship, but gives yourself both the capacity in terms of resourcing, but the capacity in terms of time as well. So again, be prepared to share this sort of thinking and recognize that if you're sat in front of the right sort of person who is an angel investor, they will have a framework that they're looking to evaluate where you sit. And if you come across as a sensible individual on your valuation, the amount you're looking to raise, the time period, where you are in your business cycle, you'll stand a much better chance of raising money with them, and because of how they're judging you as an individual, rather than someone saying, I'm looking to raise 2 million on a 5 million valuation, and I can start to build my prototype. So again, just be mindful of kind of the expectations. I've developed this personal model, which I've called the 4 Ps. And it is literally when people come to me or to TSF as to, you know, why should I invest in you? People, purpose, perspective, performance. It just gives me a little score sheet, a little dashboard that I can go, do you know what? When I met those 2 girls, they were really fired up and they knew their stuff. And it just gives me a sense of where I position opportunities. So I'm looking for people who've got profound curiosity. They're intrigued by a problem they've seen. They've done some research. They've looked at current solutions. They've got a conviction. You know, they've got some resilience. They're going to stick with this. They're all in. They are personally invested in this. And it's about building, you know, you don't necessarily want to go on holiday with these people, but if you're going to give them a check of 25, 50 or 100K, then you need to make sure they are the right people to be working with you. Purpose, I like people who've got an active edge. They're excited by what they can build. They've seen the opportunity. They've seen the gap in the market. They've seen what customers look like, the different personas, but they can build a sustainable business as well. You know, that thrill of a startup venture, those early days of hard work, putting in the effort, getting those early wins, but actually looking to build a repeatable, scalable, sustainable business. And again, I look to people that talk around sustainable outcomes, about how they're going to build a business, what their team looks like, what skills they've got, what they've not got, but overall the purpose, why they are doing this, why they're driven to do it. The perspective, they're astute, they're smart, they've thought it through, they've got some evidence, they've got some diverse thinking as well in terms of where it could go. I don't know everything, we're going to have to do some experiments. But panoramic, they've got a broad view, they sit back, they can see the big picture. They're not just focused on the business of today, they can see where this can go, they can see the scale of the opportunity. And then they are performance driven, but they're taking a long-term lens on this. Again, too quickly, people look to produce a financial model that says break even end of year 1, million profit end of year 2. Who knows? You know, it may be the right call, probably not. Take a long-term lens on your performance. Show me you understand the risks and the results that will come of that. So again, hopefully that may be of use to you in terms of some of the language and some of the focus that myself as an investor puts into these opportunities. And, you know, your heart goes out, and I admire anyone who comes to me or to TSF that wants to do their thing. They've made a brave decision to step out. And you're just trying to say, can I help these people? Can I work with them? Do I believe in the idea? Have they got the endurance, the resilience? Have they got the chops? Can they build a team? You know, investors, yes, they're looking to be part of something, but for me, it's about the people. Is there a connection there? Am I going to enjoy working with them? Do I trust them? Can I invest in them? So that brings us to the end, really, of the 4 elements in the presentation. Like to open it up now to any questions you've got, either specifically or generally. Equally happy to take stuff up and follow up offline, but yeah, over to you guys.